So bonds are another form of investments, as you know, and we'll talk about bonds. In fact, bonds plays a big part in this whole bill. I'm sure, since one of you asked this question, I'm sure all of you have sort of heard in passing about this government shutdown, this debt servicing thing. How many of you have heard of this, right? Whether we're going to raise the debt ceiling. How many of you have heard this term? The Republicans are saying, no, we're not going to allow the Democrats to raise the debt ceiling. How many of you have heard this? Show of hands. How many of you have no clue as to what I just said? Okay, good. Thank you for being honest and saying that. But so here's the thing. Well, so the federal government issues these bonds every Monday. Actually, they auction off bonds, and the purpose of these is to raise money, trillions of dollars, to have every day to fund day-to-day operations of government, which is actually not the right way to do it, because when we talk about credit in a week or so, a few weeks, that's exactly what I'll tell you not to do with credit. But however, the federal government does it. They raise these, sell these bonds to the market, to the world. China buys a lot of them. They're the largest holders of US bonds. And then use that to fund a lot of government activities, to pay out, to make all these payments and entitlement payments and all that to our senior citizens and stuff. So this has always been a big battle between the two sides, between Democrats and Republicans, and I'm going to present, I'm not taking any sides. I don't have a side. I'm just giving you both sides of this. So, so philosophically what happens is that and this happened even when Republican was a president, then the Democrats were huffing and puffing. Now a Democrat is a president, the Republicans are huffing and puffing. So it just happens, it doesn't matter. Whichever party is in the White House, the other party huffs and puffs. So that's the way it is. So these bonds are now in a big way in the national discussion because there's this looming debt ceiling crisis that's coming up. Okay, so when you hear that, what that means is very simple. It means that the bond has already been sold way before. They're just simply coming up for renewal. In other words, when you have bonds, you have to make interest payments. That's part of selling a bond. When companies do that, they have to do that. When neighborhood municipalities sell bonds to raise money, they have to service those bonds. When you borrow money for your housing or home loans, you have to pay monthly mortgage payments or car payments. That's the same thing, servicing the loan. It's the same thing, except when our government is concerned, it's a scale difference. We talk about a mortgage payment of a couple of $1,000s. They talk about mortgage payment of a couple of $1 billion. Okay, so what the Congress is now trying to stop when they say we refuse to let the debt ceiling increase is that they simply don't want to pay those interest payments. The bond has already been sold way before, right? Investors need to be paid interest on those bonds. So what the other party is trying to do now is to stop the government from paying those interest payments. That's all they're doing, right? And the upshot of that is if they succeed, then obviously US's credit rating will come down because obviously now it'll be graded down, which is never a good thing. It's already not a AAA anymore, and we'll talk more about this. So as it turns out, discussion on bonds is pretty relevant because of all this looming crisis that's sort of coming up. And again, if you were to ask me to make a prediction, I'll tell you that crisis will be averted as well. Just the same way, with major drama, until the 12th hour when things will come together magically and something will be worked out. It always happens like that. And even if government closes down, or if the debt ceiling is refused, it'll be a matter of hours before it'll be changed and things will be happening again. So, these things just happen. It's just a process that needs to be played out. So, okay, so what are bonds? Just a borrowing instrument, okay? So unlike stocks, where when you sell stocks of a company, you are bringing in shareholders. Shareholders are part owners. So when somebody buys shares of a company, they're essentially buying into the company and becoming part owners of the company. Nothing like that with bondholders. When a company sells bonds, you're simply a creditor and you buy those bonds You as an investor who's bought those bonds are simply a creditor. Okay, and the company or the government that has sold the bond is the debtor. They have sold that bond, raised money to do whatever it is they need to do. And you as an investor have bought those bonds, and you've become the company's creditor. You have no right, you're not a residual, you're not an owner, you are simply a lender of money. Just like a bank is a lender to you for a mortgage loan, the same way you are a lender to the government or to the company whose bonds you purchase. You've lent money to them. So that makes you a creditor. So, and people do that. We do that. Individuals, we raise money, right? Granted, our choices are limited because we borrow relatively peanuts compared to what these guys need. So we go to the bank. Our most common avenue of raising money when we need to borrow money is to go to a bank or a financial institution of some kind and fill out the paperwork, have a credit check done, and then get the money to do whatever it is we want to do. Government, I mean, it's the same thing. Think of a difference in scale. That's all. I mean, we may need, a couple of $100,000. A company or a government might need a couple of $100 billion. That's basically the difference in scale, in amounts. That's it. Otherwise, everything stays the same. So corporations need money to grow. Sometimes they borrow all the time. I mean, if they need to raise money, they don't always want to sell shares because that invites corporate control. That goes into control issues. These people will ask questions. Shareholders have a pesky way of asking questions you don't want to hear. Things like that. So a lot of companies don't like that, right? And they don't want to be told what to do, So companies might sell bonds to bring in creditors who tell them nothing. The creditors are just creditors. As long as you pay them interest and pay them whatever it is they need to be paid, creditors are supposed to keep their mouth shut and do nothing. So that's a good thing. Federal government does it, state governments, local governments. Local governments will sell, our municipality might sell bonds to raise money for a school, for a new school, or maybe a part of a state road, to build infrastructure, things like that. So those are the things that local governments need money for. State governments, the same thing pretty much, for financing construction work and things like that. And federal government, the same thing. Corporations do the same thing. So these are sort of some of the organizations that sell bonds. So bonds are basically just lending instruments. That's all they are. So, and so those are the examples of bond contracts, these certificates that are contracts. And so what you see there is the principal amount you're lending, which is standard amount. How much, what is the agreed upon interest rate, which is not going to change. And then the frequency of coupon payments or interest payments. The term, again, coupon payments, is a historical term. This predates computers and everything else. When things were written by hand, and when you bought bonds, you actually received a coupon book in the mail from the entity from whom you bought the bonds, whether it's a government bond or a corporate bond. You actually got a book of coupons, and your job was every 6 months to tear out a coupon, fill out whatever was needed, mail it into the company or government, and then you will get a check in the mail in response to that, which would be a coupon payment or the interest payment. And so that term has stuck, and we still call it coupon payments, although there is no coupon book anymore. It's computerized. The moment you buy bonds, your name and address is registered in the database, and every so often, whenever, you get a check in the mail. Okay, so we don't have coupons anymore, but the term has stuck. It's just historical. It's like bulls and bears kind of thing. Coupon payments. And then the term of the loan, like how long, when does the bond expire? Because lending contracts, unlike stocks have a finite date, right? When you buy a share, it doesn't have a date, expiration date. The only expiration date is when the company goes bankrupt or gets bought out by another company. That's when things might change, but other than that, your stock's still your stock. Bonds, on the other hand, have a finite maturity date. Okay, so it might be a 5-year bond, 10-year bond, 15-year bond, so on, 30-year bond. So bonds are known as fixed income securities for that reason that There's nothing bonds are relatively easy to price. Okay, as instruments, as investment instruments, they're very easy to price, relatively easy to price than stocks, for the reason that everything's more or less known. Okay, so you know how much interest you're going to get, you know over what interval you're going to get it, and you're going to know you know exactly how much, when, how, all those things you know right at the onset. So pricing that is much easier because you take those cash flows, you discount them back to the present, and that's your price. And it's much easier to do that because you know everything. Everything is known. Well, not everything, but I'm making the discussion a little simpler than it needs to be because there's always a risk of bankruptcy and all that lends certain uncertainty. But for the most part, other than that, everything else is known of a bond. So bonds are relatively easy to value. It's simply a discounted present value of an annuity stream, which you are talking about in your Friday recitations. So it's much simpler to value. And bonds are known as fixed income because for that reason, there's no variability. You get that money as promised, as long as everything goes okay. So they are fixed. Unlike in shares, when you buy stocks, they are not fixed income by a long shot, because if the company does really well, your money can, you can make money hand over fist, or you can also lose money. There's a lot of uncertainty, a lot of variability with stock holdings, a lot of risk. With bonds, there's relatively less risk because more or less the parameters are fixed. So therefore, it's called a fixed income security. Okay, so who are the major bond issuers? You can see that the U.S. government is a big issuer of bonds of all kinds. And then, of course, you have, and part of the Treasury, which is sort of an arm of the government, and issues bonds, and those are called Treasury bills, Treasury notes, Treasury bonds, and we'll talk about the difference in a second between those. And then you have corporations issuing bonds. Okay, so corporate bonds, as they're called. Those are the major ones, and then I'll let you tackle that while I look at some. Is there a primary market with bonds, much like stocks, having an IPO, or is it all fair and equal? I don't know what fair and equal means, unless you're talking to Fair and Balanced, the Fox tagline. No, that was just a joke. Okay, so that's a great question, by the way. Bonds do not have IPOs. What the bonds have is, bonds have dealer markets. So it's what is called telephone markets. So when a company issues bonds, there is no such similar thing as an IPO, but the bond dealers, the large, Solomon Brothers used to be a big bond dealer in the 80s and 90s, but there are large bond dealers on Wall Street that basically bonds are traded mostly through telephone markets. So people call each other up. It's still not transparent to the degree stocks are, which also is part of the problem with bond markets. Bond markets are not as transparent as stock markets or options markets. So if you want to purchase bonds, you have to talk to or call or email a bond dealer. Okay, bond dealer, and they're on the web also. And you can purchase bonds. You can purchase corporate bonds, but you have to call bond dealers on the phone for the most part. There is a small New York bond market, but they trade a minuscule of the bond universe, very, very small amount. For the most part, bonds are still traded the old-fashioned way by telephone across dealers. So, okay. 85%, okay, good. Well, 15, but, all right, so who issues bonds? Here's a pie chart, and you can see 20%, US Treasury and corporations. Those are the two real large issuers of bonds, okay, corporations. And here's another thing that we'll emphasize when we get to insurance. Insurance companies are big investors in the bond market. Do you know why? Does anybody know why? Why are insurance companies, these large Aetnas and all these, Blue Cross, Blue Shield, all these other insurance companies are trillions of dollars. They have trillions of dollars in the bond market. Why? Anybody? Yes?
Because the investment is safe.
They what?
Because the investment is safe.
The investment is safe. Actually, that's a correct answer. Let me elaborate a little on your answer. Yeah, you're on the right path, and it's a correct answer. So insurance companies are heavily, heavily regulated in this country. Unbelievably regulated because they are the keepers of the public money, right? When we buy insurance contracts and things, we pay premiums. All of us pay. Unless you pay upfront, you don't have a contract, right? As all of you, if you've dealt with insurance companies, you know. Before you get started, you have to make your first payment. You have to pay up first before your contract becomes valid. That means that insurance companies at any point in time, sit on a ton of cash. Okay, because all these premium dollars are coming in. So what do you do with that, right? Insurance companies are not going to put money under their proverbial pillows. They invest that money. All your premium dollars are being invested at any point in time by the insurance companies. Trillions of dollars are being invested. And of course, they're keeping the interest earnings of that. That's why insurance companies are some of the most profitable, at least the US companies in the country. But here's the thing. They cannot simply invest in whatever they want. They can't, I mean, they have the money to invest, but the government says, you can't invest in whatever. You have to invest in safe investments, because you are the keeper of the public trust. So if you take unnecessary risk and then lose it all, then obviously the public, us, you and I, will lose faith in the system, and then, of course, we have anarchy, right? So the US Congress and the lawmakers, regulators, have put serious constraints on what insurance companies can do, and insurance companies are able to, one of the few things they can do is to buy bonds. And not just any bonds, only the best rated bonds, because they have the lowest risk. So those are the bonds that insurance companies are able to invest in, and they do that. Okay? All right. So who buys bonds? Individual investors, financial institutions, pension funds, foreign owners. So if you, you might say, but I don't have any bonds. I don't care. I don't know anybody who has bonds. And you'd be partially true. You'd be half right. While it is true that directly you and I, investors like us, may not buy bonds because we don't run into banks and all that and buy bonds. But chances are that if somebody in your family has a pension plan, then they own bonds, because most pension plans have bonds as part of their investment strategy. Okay, so any kind of retirement account will have bonds in it as part of the investment strategy. So even if you don't own one directly, chances are that you own indirectly, you own bonds. All right. So here are the top foreign governments who are holders of US Treasury bonds. And this sort of, you'll see that, not to put anybody on the spot here, but China is the highest holder of US Treasury bonds. And that leads to all these discussions that you may occasionally hear about, how indebted we are to certain sovereign governments. And this, typically when people make those criticisms, this is the kind of data they're pointing at. It's like, look, China and Japan, they own this, trillions of dollars of US debt, and so therefore they have some leverage. The term is leverage. They have some leverage over our government, which is not probably true because, yes, these countries hold US bonds, but they're not going to do anything stupid because that means they will lose more in the process if they try to do something crazy. But that doesn't stop the criticism. But so that's sort of, it'll give you a top 15 holders of US debt. I'll let you take this information in. Aren't diversified bonds a better long-term investment as compared to savings accounts? The answer is it depends, and we'll address this in maybe in a class or two when we talk about bond trading strategies. But it's a good question. Good question. All right. So here's my little sidebar on the national debt that I talked to you about earlier. So we are. So we've been focused on now. Now there's another. You know, if you follow this whole thing about how much money we're spending and how much, it is true that when you go into higher levels of debt, as we seem to have put ourselves in over the last 15 years, because remember, as recent as in 2000, maybe it's not as recent in a relative scale, but as recent as 2000, the US government was in a surplus. Okay, we actually had a surplus around 2000. Okay, at the turn of the century, in late 90s, 1999, 2000, we actually had a surplus, budget surplus, which means we were actually making more than we were spending. So over the last 15 years that we've let things go to a point where we have this, whatever, 17, 18 trillion dollars in deficits, and it's growing. The downside of it is that you have to make payments, interest payments, and that requires a lot of money because you have to service these payments, which is what the Congress is trying to stop, which is not really reasonable because that's a commitment you've already made. You can't just go back and say, we won't pay it. What are you going to do about it, kind of thing. It's like you going to the bank and saying, hey, you gave me money, so what? I'm not going to make the mortgage payments this month. Do what you can, you know. That's exactly the same thing, right? You're going to the bank, your Chase or whatever, your bank loan is saying, hey, I don't want to pay your mortgage payment this month. I just don't feel like it, cause. Right? No reason, just I don't feel like it. So what do you think they're going to do? It's the same thing that others are going to do to US government, to the US government, if US government say, hey, I'm not going to pay your interest payments this period, this quarter, which is where we are headed towards right now. So when the debt keeps growing, then obviously you have to pay, and that takes money away from other essential programs like student loans and education and all this infrastructure. So that's a problem. That is a huge problem. But there is also a feeling, and this gets propagated by politicians, is that, oh, that means we're running out of money, that we have no money. No, that's not true. The US government has a ton of money. The money is invested in different things. They don't want to liquidate that and to pay off investors or bondholders. They're simply taking the easy way out by selling bonds, raising the money, and paying off the interest. That is not to say that when people say, if you ever hear people say, that means that the US government has no money. No, that's not true at all. Okay, US government has a ton of money. They just don't want to use that money. So it's like saying, and I'll close with this example today, is that it's like saying, let's say you, as an individual, you have a lot of money. You're lucky, you've done well, you have a ton of money. But people don't keep money just lying in a bank account, right? It's invested. You've got property, you've got business, you've got other things, money is all invested. And you've got a little float, bank balance of $100,000 that you maintain to make essential payments. Let's say a real shock comes along your way and you are required to pay $2 million quickly. Well, your option is what? To sell certain investments you already have, which might be very costly for you to get out of right now, because you can free up that money easily, but it's going to be very costly to you. Or an easier way is to just go borrow that money and to pay off your creditors. That's essentially what the choice is for the US government in a larger scale. Is that, do you just simply borrow this money or raise this money by selling bonds and thereby raise the debt ceiling and pay off your investors, or do you actually liquidate critical assets to pay it off? The US government has chosen not to liquidate critical assets. They just simply take the easier way out, which is exactly what's going on right now.